So I thought today we'd go through just a little bit of a typical economic forecast, market outlook, and then broaden it out to beyond just the immediate 6 months and talk about some longer term trends and how that's going to impact our investment strategy and portfolios. Like everybody else in the industry, we produce forecasts. Like everybody else in the industry, they're wrong, but we produce them anyway. The struggle with forecasts is that we have the responsibility, like all of you, that we actually manage money. So forecasts have to be relatively prudent in looking at the most likely scenario. Unfortunately, your clients get to listen to the media where the most attention is given to the most outrageous scenario or the most provocative scenario. So when we publish these and we talk with our clients, they say, yes, but there was some guy on some television show that said, you know, the S&P was going to close at 1,500 or the S&P is going to close at 2,500, and that's always the struggle. So this is the most likely scenario, and then as the year unfolds, we can make adjustments as reality comes to fruition. These all look pretty realistic, I believe. So the 3.6% GDP at the global level, we basically do it at all the countries individually and then wrap them in regionally and then wrap them into a big global pie. That has China at about 7.5%, emerging markets on aggregate outside of that at about 5%, US growth at about 2.4%, rest of the developed world at about 2.0%. You add that all up, bing, bing, bang, boom, 3.6%. So I think that's pretty realistic. Kyle talked about this number, which is a terrible struggle right now, and it's because it doesn't really tell you the story of the labor market. So 6.2%, we just revised that actually. We had developed an unemployment target of 6.7 in October. Well, we hit 6.7 by the end of the year. It's not that there's that many more people working, it's just the fact that nobody's even trying to go to work anymore. And that's the problem. Labor participation rate has collapsed. So it's fun to lay by the pool, but that doesn't really produce a lot of GDP, and so enormous concern there. And a lot of the excuses around it's the baby boomers retiring. That's a little bit of it, that's not a lot of it. A huge part of it is the people between the ages of 20 and 30 that aren't trying to work. They're either hiding in academia or hiding in their parents' basement or not being very productive at all, and that's an enormous concern for the longer term trajectory of the economy. I think back when I was in my 20s, I was living in San Francisco working at Wells Fargo Investment Advisors, didn't make any money. One paycheck went to rent, one paycheck went to the rest of my life. And we were doing some pretty interesting work. That division had developed the first institutional index fund for the Samsonite pension plan. We developed index arbitrage, portfolio insurance, those sorts of quantitative and factor model trading. It was pretty interesting stuff. And then I really started developing more personal economic benefit in my 30s and 40s. But those years where you're young and hungry and very intellectually interested, we're missing that in the current group. And that has long-term ramifications for GDP growth. So something to watch for and pay a lot of attention to. Market forecast, 3.5% seems normal, I think, on a 10-year treasury. We're kind of moving that direction. The equity numbers are actually being revised right now as we speak. We'll probably put out new numbers next week. I could make a guess at them, but then you'd be able to front run us and then you'd get arrested, and that all leads to a pretty bad outcome. So the way we get to the S&P number up there is we start with earnings. So we had an earnings forecast of 113.5. Then we apply a multiple of 16.5 and we get to the index level, so that's pretty standard stuff. We had a bit of a surge of GDP at the end of last year. So we're really waiting for clarity through the earnings season to see if that surge then equated into a little bit of a surge in earnings. Do we need to change our earnings forecast? I won't let them change the multiple. Everybody wants to change the multiple, but I think just at this point, betting on multiple expansion is a little Pollyanna-ish, and then we'll apply a new multiple. But the earnings number won't go above 115. They might get to 114 or 114.5 or something like that. Emerging market may come down a little bit, not a lot. IFA, I don't know if it'll change or anything. So that's the current forecast, and then we're going to talk about some longer term themes, and I think that this goes back to the conversation we had earlier about behavioral finance around anchoring. That people get very stuck in a certain mode and they think, you know, that's what I'm comfortable with, that's what I know, and that's what we're going to do in the future. I think some of these themes challenge that. People are stuck in the mode that the global economy is going to be led, just like since World War II, by Western Europe and North America. We don't think that's the case for the next generation. It's going to be very different. The last generation of investors have only experienced declining interest rates. We don't think that's going to be the case for the next round of investors. The investors are used to consumers in North America and Western Europe buying and consuming and eating a lot of stuff. We don't think that that's the group that's going to be consuming and buying and eating a lot of stuff going forward. There's other consumers around the world, and that's what we're going to talk about, and that has massive ramifications for investment strategy going forward. So technology and energy. So somebody had asked about Bitcoin. It falls into this technology thing. So Bitcoin is a currency. There's lots of currencies in the world. We're used to like US dollar type currencies. Frequent flyer miles is a currency, just not issued by a government. It's issued by a corporate entity. You collect them in an account. You know for a fact that every year they're going to devalue it by some amount, but you still collect them in an account. It's part of the game. You trade them for goods and services, so that's a currency. Twinkies can be a currency. We've all traded a Twinkie for a peanut butter and jelly sandwich, so there was some value in that on a playground, so that's a currency. It's issued by a corporate entity. Bitcoin, unfortunately, Bitcoin has become Kleenex, right? It's the word that everybody uses for virtual currency. There's about 80 or 90 virtual currencies. Only about 7 or 8 are actually valid. But they always use that one word, which is too bad because that's actually a brand. The problem with that brand is they got a nice market share and a nice brand recognition, which was great, but they blew it with being very cavalier around fiduciary responsibility and regulatory authority. That you really shouldn't develop a global product that supports criminal activity that would destabilize the human capital system. It's probably not a good long-term business, and when you have your vice chairman arrested for money laundering, it's an indication the business model has some glitches in it. So this concept of internet currencies or electronic currency, absolutely valid. You and I can agree on how we're going to trade value, but having a company like that is literally one criminal transaction away from insolvency, it's just not a long-term strategy. So yes, that concept's good. Bitcoins is a train wreck waiting to happen. Technology is changing everything that we do. It's changing what we wear, internet glasses. So even at Wells Fargo, we have a vision plan in our health plan. I just got a message about a week and a half ago that they have done a deal with Google Glasses where we can get discounted Google Glasses through the Wells Fargo health plan. I have no idea why I'd want that, but apparently these are progressive lenses, so I've just finally gotten used to these so I don't walk around vomiting and dizzy all day long. So now I want an internet search screen right here. I guess that would be fun. I don't know why. These bands that tell you how many calories you're burning, what's your metabolism, all that sort of information that we're supposed to know that we don't want to know. That's all around technology. Which is, last week I walked into the gym at home. I usually travel one week and I'm home one week. And I walked in the door and there were these two, spectacular 22-year-olds behind a table. And I said, "Would you like a free fat evaluation?" Like, why would I want that? Like, why on earth would I want somebody that looks like you telling me how much fat I have? No, that is not what I want. But this technology that's happening is telling you every aspect of your life. We're trying to come up with what has technology not changed in your life? And the one example one of our analysts came up with was the knot you use to tie your shoelaces. That really hasn't changed much. But virtually everything else in our lives has been changed by technology. And it's not just us. It's a global consumer that we need to pay attention to. All of this stuff, all of this data has to be stored somewhere. So the storage and security of it, as we've learned recently through the Christmas holiday season, is critically important. The volume of stuff is just amazing. It all has to be stored somewhere and sorted. My professional mentor, her master's degree is in library science. So she is unbelievably organized. She's a great fundamental research analyst, can get stuff. She thinks the internet is just anarchy, chaos, cannot stand it. Because as you search things, it's just stupid. It's not done by date. The opportunity for managing this data is incredible. The number of pictures that are out there is just stunning. Everybody takes a picture of everything now, and it's being stored forever. I am so glad Facebook did not exist when I was in college. The things that I would have thought were very important to tell the world when I was 20 years old, I would just be horrified today. It would be lots of bongs and Madonnas everywhere. It would be just an awful, awful experience. I was recently on a research trip to India, and I was in a mall in an area that has a lot of international businesses, and there were 4 Muslim women sitting there in the full scarves and burqa, and I was watching this scene unfold, and one of them reached into a bag and pulled out some sort of a phone and reached it out like this and took a selfie of all 4 of them. Not that you could tell who any of them were, but they would have this picture. And that picture is being stored. So, I mean, the global phenomenons of marking data, marking time and storing it are just massive. 3D printing. So you can buy a 3D printer now for your home, right? You can spend $1,000 or $2,000, take it home and make a paper clip or whatever you want to make. There's 3D printers now. You can make a trailer home, right? A mobile home. They're these massive things. They're even in a script on television now about they lifted a fingerprint off of a glass, put into a 3D printer, made somebody's hand, used it to enter some security area. It's becoming the technology. The issue with this is the resurgence of manufacturing around the world, which is true. The problem with that is at the labor side. So with this, the labor that's needed in manufacturing isn't the guy that can screw the screw fastest and tightest. It's the person that can program the robot that can screw the screw fastest and tightest. That's the job. So when we look out at the labor market today, do these people have the skills to program the robot to do this? And the reality is they don't. So we have this little bit of a disconnect between the labor need and the labor quality, and we have to work on that. So when we talk about manufacturing, it's not about the big, strong guy that can lift 150-pound something. It's about the brain that can program machines like this. It's very, very powerful. Energy resurgence. This is a picture of the United States. These are burning off of gas. So that's up at that North Dakota minefield. If you want a business, open a branch there. There's only 4 people there, but they all have a stunning amount of money. And there's nothing to buy there, right? There's literally nothing, so they have to invest it with somebody, so go open a branch up there. So there's Chicago, and there's the 4 guys working in the fields in North Dakota. This energy resurgence is changing the world at every level. We talk about it internally, right, in terms of energy independence in America and not using much OPEC oil. Well, we're not the only ones with this technology. It's being done all over the world. This is an energy independence chart. When I was in India, we were out in Mumbai Harbor. India imports 80% of its oil. 80% of the oil that is consumed in the largest democracy in the world is imported. We are out in Mumbai Harbor on a boat. There was a line of oil tankers offloading oil into this massive facility that was built there to bring all this oil in to feed the energy needs of 1.2 billion people. Every single ship was Iranian. Every single ship was an Iranian oil tanker. And I looked at the guide and I said, should we be here? Because I'm pretty sure there's a US drone pointed right on this row of ships. Like, we should probably be a long way away. And all the talk around sanctions on Iran and the world effort around that, but apparently they can sell as much oil as they want to the largest democracy in the world because those people need electricity. And so we met with the Minister of Finance and the Minister of Infrastructure, and he said they're spending a lot of time working with international companies, most of them American, by the way, importing this technology of fracking into India so they can increase their domestic supply so they don't have to buy so much oil from a very volatile source like Iran. So when we look at this sort of fracking technology, I think it's important to understand the global perspective, that if you are building infrastructure in an emerging or frontier economy, you are not building a power plant that uses OPEC oil. You are building a power plant that uses natural gas, and a lot of it will be developed from internal resources. So huge, huge game changer. Second theme around activist central banks, we've talked a lot about this. United States is slowly kind of tapering. They've ruined that word for the rest of the English language, but we all know what it means. This group here is still pedal to the metal, right? As much flooding as possible. This group up here is trying to fight inflation. So we have these divergent central bank policies around the world. This affects interest rates. This affects currencies. It infuses volatility, which we've obviously seen. So this divergent central bank policy is very important for us to understand. How does it impact all these different factors that then then rifle through the capital markets and have the capital markets acting the way they've been acting. This is where the volatility is coming back. In the last 2 years, we really haven't had that much volatility. Now we're getting back to kind of normal levels, and we think a lot of it is because of these divergent central bank policies. You all know this graph forever. So this is Janet Yellen's job, right, to figure out how to unwind that. So you don't really have to actually sell the bonds, right? They'll eventually mature. They'll eventually come to an end. But you do have to stop buying them at one point, and that's what they're slowly doing. If you remember back last year, middle of the year, first time they used the thing tapering, and they said they might take off $10 billion from an $85 billion purchase plan, and the whole world kind of fell apart for about 6 weeks. Markets went down 5%, bond yields went up 50 or 100 basis points, volatility. Oh my God, the Federal Reserve is going to shut down the world because they're going from $85 billion to $75 billion. You know, the $85 billion number is so stunning. It's $1 trillion a year. It's $1 trillion a year. I didn't even know we made that many bonds in this country. Apparently we do, because they're buying them. It is an amazing number. So this is a long, long process of trying to unwind just the buying program. So this is going to take a year and a half, right? If you do $10 billion a month, every month, it's not going to happen every month, right? There's going to be hiccups along the way. We have a midterm election coming up, for crying out loud. Pretty sure they're going to slow down tapering as we go into that. So this process is a long, long road that's going to affect our investment strategy for a long time. And that comes where we talk about interest rates. So herein lies the problem. This is where I graduated from college, right there. For a generation of investors, they've only experienced declining interest rates. Your clients still have in their heads that I have bonds for liquidity, cash flow, and stability over here, and then I own stocks over here for volatility and growth. And depending on my mood when I go see you, will be 50-50, 60-40, 70-30. You know, they'll just pick whatever asset allocation between those two. And the way these bonds were typically managed was in some sort of a laddered portfolio. So you put $10 million into the bond market, you buy $1 million of bonds every year. By the 10-year bond, it slowly collect the coupons, it slowly matures, comes to zero, then you flip it back out to the end of the ladder. So what you're doing is you're taking very short duration risk, buying longer duration risk, and that's wonderful in a declining rate environment. So interest rates are at zero. They're going to go up. Not a lot, they're not going to 20, but they're going to go up. And the mindset for your clients is going to be dramatically different. Last year was the first year in a long time that they saw negative returns in the bond portfolio, and that's going to go on for a long time. So we have to rethink bonds. We like the liquidity characteristics of them. We like the cash flow characteristics. We like diversification. What we don't like is interest rate sensitivity. So is there a way to structure these portfolios so we can extract what we like and help immunize or protect us from what we don't like? The reason why it's happening now is that, in fact, they were talking about it with the economists. Capacity utilization is slowly coming back up to approaching 80%, which is typically the level where you start to get capital expenditures. So the Federal Reserve looks at that, says, okay, now is the time to start pulling back a little bit and seeing if we can have a bit of a self-sustaining mechanism. The business will go and start doing capital expenditures. We don't have to be flooding the economy with money, blah, blah, blah. We've seen that, but unfortunately right now businesses are investing in infrastructure to improve capacity as opposed to labor. Maybe if the labor gets re-educated, we can change that. But this is why it's starting to happen now. That's why the Federal Reserve is starting to do it now, because capacity utilization is up to a level that justifies trying to unwind this experiment. So our graphics department went berserk on animation on the slide, so it's always fun to watch. So when we talk about fixed income with our clients, it's about not just picking whatever yield curve you're comfortable with and then building a laddered bond portfolio, but extracting the opportunities across the different yield curves and really managing credit risk. So instead of manipulating duration risk in a declining rate environment, we want to be able to trade the credit spreads, the credit risk in the fixed income market. It's a little bit more like an equity type approach. Looking at valuations in the portfolio, but I think that's important. So the number of asset classes in fixed income has really exploded. We have to be much more active on how we position those in the portfolio and get people comfortable with not just treasury bonds, which are just awful, corporates or municipals, depending on the tax circumstances, but high yields, preferreds, non-dollar denominated, developed, emerging, lots of different mechanisms, and then also looking at cash flow in other asset groups, global equities, global real assets that can produce cash flow to help support income. So they're not just looking at their bonds for income and looking at stocks for growth, but being much more holistic in the portfolio. I think that's pretty important. Demographics. So, Wells Fargo is very cheap, and so they decided that they use pictures that I take. They don't have to pay copyrights, so I took that picture. That is rush hour in Hanoi. If you've ever been there, you are accosted by a tsunami of motorbikes. Some of them have one person, some of them have seven. But there's just the wave of motorbikes is absolutely stunning. And I took the picture because of this guy here, and he was doing the experiment. We were with an interpreter and a guide, and we needed to get across the street to this office building that we were going to. And there's literally a wave of these motorbikes coming at you. I said, how are we ever going to cross the street? And he said, well, what we do is if you just step off the curb and just walk in a very consistent pace, do not change velocity, don't show any fear, and they will go around you. So I'm not compensated nearly enough for that sort of country-specific risk. But I am telling you, it is true. They go around you. It is the most astonishing experience. So when you go to Hanoi, step on the street, do not change velocity, they will go around you. See how much, look at the confidence in that man. It's very confident. So world output. Last year and next year, as the world changes and the output of these countries change, paying attention to this sort of demographic shift. Where is the growth coming from? Where is the economic activity coming from? So this is not at a per capita basis, obviously, but I think it's pretty important to pay attention to those demographics. You can see India kind of inching up there, Europe inching down there, those sorts of things. I really like this one. So here's 1950, right? So a lot of our clients think about the world from 1950 to 2000, and then they extrapolate that out to the next 50 years. You look at the countries on this list, we recognize most of them. These are ones that people like go on vacation to, right? So we have France, Italy, UK, Brazil, Germany, blah, blah, blah. You kind of recognize these names. Then we go to 2050. So this is the top 10 in terms of population. Only one country is in the developed world. India becomes the most populated. India will be the most populous by 2020 or 2025, so pretty soon it'll happen. And then you go down, Nigeria, Pakistan, Ethiopia, Bangladesh, Congo. I mean, it's a pretty stunning list of countries with a demographic wave. So that's the first part of the equation. Where are the people going to be? That's where they're going to be. So, but that's one part, I said. The other part is, are they doing anything? Like, it's one thing if you're just sitting under a tree, waiting for grass to grow, but are they actually consuming stuff? And they're starting to consume stuff. Another picture to save the bank some money. So this is the per capita GDP. We all in total, in Americans, spend about $50,000, not this room, but Americans in average, spend about $50,000 a year on stuff, right, GDP. There is nothing else for us to buy. We have bought and consumed and eaten everything there is to buy, consume, and eat. We're done. We're full, right? Well, you go to these other places like India. I didn't talk about that a lot just because I was there, so I've got India on my mind. $4,000 a year. So they can consume their consumption 10 times, and they're still not consuming what you're consuming. Yet they all know your lifestyle, and they want it. And they know your lifestyle because each of them has a handheld gizmo. Every single person has a handheld gizmo that you had 3 or 4 years ago. That could be in Phnom Penh, in Ho Chi Minh City, in Delhi. They've all got them. So they know how you live. There's only one country that doesn't know how you live, and that's North Korea. It's the one country that they've been very effective at insulating their population from global communication. But everybody else knows how you live, and they want to live that way. And when you see that divergence of consumption, that's where you start to see the opportunity. So they're really starting to consume more. We're seeing higher and higher per capita GDP. So today we have about 2 billion middle-class consumers around the world. By 2030, we're going to have 5 billion middle-class consumers around the world. Not your middle class, but a consumer middle class. So those people don't live in Texas. Those people live in other parts of the world. We need to make sure that we have investments in companies, in industries, in sectors that are getting to those consumers. So we have the benefit of living in the United States where we have a lot of global reach in our economy, so it's a little bit easier for us. But just owning Procter & Gamble isn't enough. We need to go deeper than that into getting to these consumers. We did this analysis of, so what do you buy when you go from $1 a day to $2 a day to $5 a day to $10 a day to $100 a day? What is it that you buy? So the first thing is food, right? You change your diet and you start eating meat, very environmentally inefficient, but it tastes incredibly good, and so you buy it. In India, eating cows is a serious issue, so you don't do it there. In fact, we got to this one airport in the middle of nowhere, and there was a McDonald's, and they had a Maharaja Mac, which I just loved beyond belief. It's like this vegan grass patty. It's just nasty. But it's a Maharaja Mac. One of the interesting analyses is, so food is the first thing, right? So that's the kind of a commodity-based, getting production and distribution, all that sort of stuff. One of the interesting analysis that came out of this was, one of the first things you buy is a washing machine for your clothes. That's what that last picture there is. It's a washing machine. One of the last things you buy is a dryer, because you can just dry clothes on a line for free. And so why would you spend your money on a machine that you really don't need? And by the way, you don't have an electric grid that works all the time, so it's not even going to work most of the time anyway. So just hang them on the line. So in this country, very few people buy a washer without a dryer. You buy them as a unit. But at the global consumer level, they do not do that. It's about a 5-to-1 ratio. So when you're looking at investments, if this factory is producing the same number of washers and dryers, we have a serious problem. There's going to be this way over, no one's drying clothes in a dryer because it makes them smell terrible. So there, those opportunities, obviously communication, then we go into leisure. Apparently one of the first things people buy is an ugly Russian car. I have no idea why they would buy that car, but our marketing department thinks that's what they buy. So when this analysis of the global consumers, what are they buying? And we need to stop thinking about us and what we buy. When you get an extra $100 or $1,000, what you buy is very different from what the global consumer buys in South America or developing or Eastern Europe. That's how we have to look at it. So when we look at our investment strategies, global stock markets, thinking globally. One of the great exercises I go through with our clients is, so what does the global portfolio look like? Just the neutral global portfolio. I'm out in outer space looking at planet Earth. I want to buy that index fund. What does that index fund look like? So if you weighted it by population, about 95% of your assets are outside of US currency. Seems a little extreme. So if you did it by GDP, economic activity, 80% of your assets are outside of US currency. I think that's worth noting, by the way. Market capitalization, all the stuff you can actually buy, sell, stocks, bonds, limited partnerships, real estate, blah, 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 that kind of stuff. About 55% of the assets are outside of US currency. It's a good starting point. Then you layer on top of it a home country bias. Every investor in the world does, every investor in the world should. You always overweight your primary liability currency. Make the assumption that most of you in this room, when you go to the grocery store to buy a loaf of bread, you have to pay for it with US currency. You cannot use Japanese yen in your local store. They force you to make the currency conversion. So you always overweight your home country main liability currency. So when we look at our global portfolios, we start in the more conservative fixed income asset class around 25 to maybe 30% outside of US currency. In the higher growth asset classes of global equities, global real assets, and alternatives, closer to a 35 to 40% allocation outside of US currency. And then we think that that gives you a good global reach of really what's happening around the world economically, and also an appropriate home country bias. Fixed income. Changing the way we think about bonds is really important. Just before Christmas, I met with a family that they had made their fortune, right? They just sold the company. This is all the money they needed for this generation and the next, and they were done. And he actually said to me, he goes, I just don't want to lose any money. This is it. We're done. I don't want to lose any money. Don't put any money in the bond market. Just put it in the stock market. Like, wow. I would have loved to have talked to him in 2009. how that would have had played out. But that was his mentality. So there's these two kind of camps building of just, we know interest rates are going to go up, and when interest rates go up, the price of bonds go down, so let's not buy that. And then the other camp of just ignoring it. I know that if I buy a 30-year bond, I'm going to get the principal back when it matures. It doesn't matter what the valuation is between now and then. I'll collect my coupons and get the principal back, which is true most of the time. The problem is, what is the value of the currency that they're going to pay you back that principal? It will be eroded by inflation. So the value of the currency you're being paid back has gone down significantly, so the buying power collapses. But changing the way we invest those portfolios, I said, we like liquidity, we like cash flow, we like diversification, we don't like interest rate sensitivity, reduce maturity risk, duration risk, exploit credit risk, go to different yield curves, be much more active in the portfolio, trade the spreads, that sort of approach to fixed income. I think it has to be a lot more active than what we've been doing in the past. Real assets and complementary strategies. Complementary strategies is our marketing word for alternatives. We actually use that. I thought it was clever. I'm not a marketing person, but when they came up with it, when they first came up with it, I thought it was stupid. But then when they explained it to me, I thought, okay, I'll buy that. If you know, it's complementary with an E because it completes a portfolio. If it was complementary with an I, we would say because we think hedge funds are pretty. That's not what we said. It completes. So when we look at the portfolio, it's like, what are the risks that we're not exploiting in this portfolio? Are there other strategies, private equity, private debt, hedge funds, managed futures, some other sort of risk that we can exploit in the capital markets? And that's how you use complementary strategies to round out the risk exposure. Real assets of real estate and commodities is really around, are we getting to the fundamental resources that these global consumers are going to be consuming over the next generation? I think it's very important. So when we look at our investment strategy, there's four big groups of global fixed income, global equities, global real assets, and global complementary strategies or alternatives. The issue with commodities is people get fixated on usually two, gold and oil. So both of them are not very attractive. But when we look at commodities, it's really around agriculture, so that's what people will eat, metals, which is infrastructure metals, and then energy, this broad energy complex around the world. You know, most people don't consume the amount of energy that we do in this country, and they're doing it. So when we talk about these investment themes, I think it helps to redirect our clients' thought process closer to their investment horizon. You know, too much of the information they're getting today is very, very short term. It's what's fun, what's sexy, what's provocative to be said today. But when they look at their portfolios, sometimes they're still looking backwards from World War II to today, and what worked then, well, we'll just extrapolate that out to the next generation. We think there's a generational shift here. Then we need to rethink, what is the global economy doing today? What's it going to look like in 10 years? Who are the drivers of that? Where are the consumers? What are they going to be consuming? And we need to change the way we invest our portfolios for our clients and help them think on a very different level. It's been pretty successful for us, and it keeps our clients from making short-term emotional decisions, a lot of what he talked about during the behavioral finance discussion, which is very, very common. Like the guy who wanted to just get rid of all of his bonds and only buy stocks before January of this year, by the way. So, and then after this, there are 4 or 5 pages of disclosures that look like that none of you are going to read. I do have somebody on my staff that actually sent those back to me, and she had copy edited them with like commas and, you know, all the grammar. And I said, don't touch those slides. Lawyers have written those. Nobody reads those. Everybody has them. There's literally 4 slides of that. I find it just astonishing that we have to put that in there. So with that, I'll stop and see if there's questions or comments or disagreements or topics I didn't hit that you wanted me to hit. Yes. I know him, by the way. Hi, Fred. So he's asking, after the lunch presentation, would you have a different investment strategy if we're going to a deflationary environment versus an inflationary environment? So the short answer is yes. And when we build capital market assumptions, the way we build investment strategies, we define asset classes, and then we build capital market assumptions for them. We do a building block approach, start with an inflation rate and build risk premiums, going up from cash to intermediate bonds to high yield equities, blah, 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 and do that. So we start with an inflation rate. One of the things we've been talking about recently is we only currently use one inflation rate. And I'm thinking we need to have two. We need to have a domestic inflation rate and an international inflation rate. The two of them combined would be a global inflation rate. And then make a determination of, is the risk premium of this asset class determined by the domestic inflation rate or the global inflation rate? And I think it is fair to make an assumption that in the developed world, I don't think deflation is going to, sustained deflation is going to occur. Across the broad aspects, there'll be small systems that will go through that, but not on the broad aspect. But the global inflation rate will be much higher than the domestic inflation rate. And I think that changes your investment strategy. So I think that by next year, we will probably have that bifurcated strategy of two different inflation rates, and how do each asset class get impacted by the different inflation rates? Because yes, it is extremely important to building out the investment strategy, and I think today we do it a little too simplistically. But I think deflation is not, it's pretty easy to create inflation, just flood the system with money. Yes, right on the aisle.
How do you define semi-liquid credit?
So ask me, how do you define semi-liquid credit? So give me an example, like an asset class.
I just heard it last week at the Austin CFA.
So we have, on the private, we have three private asset classes. We have private real estate, private equity, and private debt. And the theory of those is that there's a great level of illiquidity in those asset classes. So when they're into a portfolio, we know we're not going to be able to rebalance them quickly. The position is going to have to be in there for at least 5 years, that sort of stuff. That's a struggle. That illiquidity risk is actually paid pretty handsomely, because Kyle, the guy who was talking about Argentina. I mean, that was a great example of being able to exploit illiquidity risk in these bonds, and if you can ride it out 3 or 5 years, that sort of stuff. So we like that a lot, but emotionally it's really hard for clients to ride through that. And then we run the risk of how do you value them, and there's all these kind of regulatory issues. So we do have 3 specific asset classes for it. The allocations are pretty modest. We don't like having illiquidity in the portfolios in aggregate greater than 15%. It just creates a lot of consternation. There are some clients that can tolerate more. The one challenge on illiquidity risk is it's the one thing where size actually matters, and that's the struggle. So my personal portfolio can look like the CalPERS pension plan, right, through an asset allocation structure. And you can make that argument. But illiquidity is dependent upon the size of the portfolio. The actual asset allocation can be the same if it's $1 million portfolio or $1 billion portfolio. But illiquidity, because if I have $1 million, having 50% of illiquidity is probably too much. So I'm now down to only $500,000 to be able to spend, or if something goes wrong. But if I have $100 million, is it too much to ask that 50% of it invested to exploit this illiquidity premium? I don't think it is, because the horizon is long. This is multi-generational money, but few people do that. So that's one of the aspects in our strategies that we have. Is it's not just about risk and return, but really time horizon and that illiquidity risk being able to extract it. So we do have private debt. We like it a lot, but unfortunately, emotionally, it's pretty tough to get allocations above about 7 or 8% in the portfolio. Very, very difficult. He's asking about correlations around the world and increasing, decreasing, and implications. Serious problem, right? So the whole thing starts with, we have a correlation matrix. We actually do pure historical correlations. We take the series of returns. We don't weight each year the same. We actually overweight the most recent observations, the theory being that we're capturing a glacial trend in correlations faster that way than if we just take a 15-year series or 25-year series, whatever it is, and each year gets the same amount of weight. So that's how we do it. They are obviously trending higher as the world is becoming more and more globalized, and I think that's fair to say. But the asset classes available in portfolios is very different. You know, it would be very difficult today in a court of law to defend a fiduciary portfolio that's only investing in cash, in a money market vehicle, in treasury bonds, and in large cap domestic dividend paying stocks. You'd be challenged that you're not diversifying that appropriately. So it's evolved. So I think that one way to address this increased correlation in the traditional asset classes is by these new asset classes that we're able to exploit in private client portfolios that we weren't able to before, private debt, you know, being one of those sorts of things. So they're definitely trending higher. Which reduces diversification. And so diversification is about defining other asset classes, other investment opportunities that clients can exploit the capital markets besides just traditional long-only stocks and bonds and cash. Yes?
I may have read it wrong, but it looked like on your forecast that less than the emerging market from the end of 13 to the end of 14. And that seems to be contrary to a lot of the conventional wisdom we're hearing about emerging markets.
So I could blame that on the fact that you're sitting way on the side and it was all distorted, but you actually read it right. So those are being evaluated. So two things about that. And the growth rates are still pretty high in emerging markets, but the S&P number is low. It's probably going to get moved up a little bit. But what I liked about it is it reset people's expectations. After a year like last year, it's amazing how clients, somebody was presenting here and how, you know, clients you've all experienced, they come in and they're all pissed off that they got 12% return last year. Like, really? You have a return like 10% above inflation and you're angry? It's like, I am so encouraged that we've moved back from a place of fear to a place of greed. You know, at least human nature, we're back. So one thing about that number is it helps to reset it, right? It brought us, we're just a little, our capital market assumption is around 7-8%, something like that. So we're just a little bit below the capital market assumption, and I think that helps to reset that. The emerging market number was done like in the middle of the fourth quarter, so before the current swoon. So what we're going to do is we're going to kind of take the capital market growth rate from the current lows and probably extrapolate them up a little bit. We have to pull down the earning numbers, so those will get changed somewhat. So it's a little bit of kind of manipulating mindset of the investor. But you're right about that analysis. I keep moving because that way I can see the clock there.
Think about forecasts, they're always wrong.
They're always wrong, and what I was like, we have economists, and last year, it was right around the end of October, beginning of November, and they were going to change the year-end forecast for 2013. Like, wow, really going on a limb there. My goodness, you're going to call that last 6 weeks on unemployment rate. I'm impressed by your veracity there. Any other questions or topics? Right in the center.
What's your opinion on the massive amount of monetary stimulus all around the world?
Massive monetary stimulus all around the world. So that goes back to that inflation question. I'm kind of one of those old line people that I think, you know, if you flood the systems with money, that people will spend it, and that creates inflation. I think the greatest study I ever saw was around POW camps in World War II, where the currency was cigarettes, and they're a currency. The benefit of cigarettes is you can consume them. So when the cigarettes were sent into the camps, the price of, you know, a pair of woolen socks or gloves went very, very high. And then as the cigarettes were consumed, the prices came down. So we see inflationary pressure. You know, we don't have inflationary pressure here. But when you go into other economic systems, it is the problem. In India, 30% of the food doesn't even get to the consumer because it rots. So the demand is so much greater than supply, and when they have this flood of global monetary instruments around the world, they want to buy stuff, right? And food is one of the first ones. So inflation, right? And that's where it comes to. And we were talking about that with the difference between domestic inflation and global inflation. And I think that we have to start doing that in our strategies, because the difference, it's by a magnitude of 2. The global inflation rate is almost double the domestic inflation rate. So it creates inflation, which actually creates economic activity. The Federal Reserve, you know, central banks like that. The whole point is, let's keep interest rates low so that you borrow money. You know, you'll be enticed to borrow money. You're not borrowing money. I work for a bank, so I know for a fact none of you are borrowing money. Would you please borrow some money? And the Federal Reserve will feel happier. The other one is inflation, is that if you need to have buy a pair of pants, you're being incented to buy them today because you will think they're going to cost more tomorrow. But if you think they're going to cost less tomorrow, you will wait. So that's the whole point of inflation, is to keep, move that velocity of money forward. And I'm a believer that it will kick in. And when we see global inflation, it is double domestic inflation, and that's driving a lot of economic activity. So they're waving at me in the background. And one more, and that's not because she says, "Oh, you're so much fun." She's like, "You need to stop talking." Yes.
How much home bias is appropriate instead of changing over time?
How much home bias?
Well, you said we should have some home bias, whatever you also put out, how much is going to be.
Uh-huh. So the example I gave you was, if we started from a market cap portfolio to apply home bias, then we take off about 15% from that to add to home country bias. So that's a bit of our recommendation. Put in perspective, we are a fiduciary. We have actual authority over the assets. Kelly's one of the people that actually does these things. Our book of business isn't even halfway to our recommendation. So it shows how strong that home country bias is for American investors. And I just did something. The guy back there will fix it. So I think that shows how important it is to keep that conversation going. That our investors don't look globally; they look domestically. I think shaving 15% off market capitalization is realistic. But when we look at our actual book of business, our clients shave off about 30%, and I think that's too much. So start with market capitalization, take off 10 to 15%, and that's a good portfolio. But you're going to have a battle on your hands. Most investors won't like to do that. So thank you very much for the time. Oh, that's the disclosure slide that nobody wants to read. And I'll be around afterwards for questions. So thank you very much for the invitation. I've enjoyed it. Thank you.